Oil pulled back on Friday, but the week still left a real inflation problem behind. Welcome back to this week's market recap. The conflict and shipping threats pushed crude above $100 before that late relief arrived. That matters because expensive energy feeds inflation, lifts bond yields, and makes high-value technology stocks harder to defend. Tariffs added another cost threat just as business activity and jobless claims showed the economy was still running firm. I think sellers still have the better argument in technology, while the broader market is only bending, not breaking. Buyers need to hold Friday's stabilization and bring yields in oil lower. A renewed surge in either one would put the pressure straight back on stocks. The Dow Jones Industrial Average gained about 0.5% on Friday but still finished the week slightly lower. That tells me buyers are defending the old economy side of the tape, but they have not fully repaired the weekly damage. The S&P 500 barely moved higher Friday and lost a little more than 0.5% for the week. Broad buyers are still holding the line, but they are not pushing with enough force to call the pressure finished. The Nasdaq Composite fell roughly 0.6 on Friday and more than 2% across the week. Growth leadership is giving ground, and that is the clearest warning inside an otherwise steadier index picture. The VIX eased slightly on Friday and also ended the week lower. Fear is not accelerating, which helps, but low volatility cannot rescue the market if yields and oil turn higher again. Bitcoin slipped about 1.5% Friday and ended the week modestly lower. Speculative demand is cautious rather than collapsing, so liquidity has weakened without disappearing. The main macro problem is still the same chain. Conflict risk lifts oil, oil lifts inflation pressure, and that keeps the Federal Reserve from giving markets easy relief. Strong activity data and very low layoffs made that policy problem harder, not easier. So we start with SPY and the broad market under pressure. I want to see whether Friday's stabilization is the start of real support or just a pause before oil, yields, tariffs, and wheat technology leadership push back again. The rising wedge is broken, and 2 consecutive closes below support confirm that sellers have taken control of the short-term structure. This pattern compressed for about 70 days before failing, so rallies now look vulnerable until SPY can reclaim the broken boundary. The first rebound test sits around 744.45. The 50-day average is almost directly above it near 745.07, which turns that whole area into resistance rather than support. A quick bounce into that zone would not change much for me. Buyers need to recover 745 and hold it into the close. If price reaches that area and fades again, the breakdown stays active. The lower decision area is around 733.6. I would not treat a brief move underneath it as enough. Sellers need acceptance below that level through the close before the next downside extension becomes more likely. The measured move from the wedge points towards 790.92, close to the 200-day average near 698.54. That is a much larger move, not an immediate call, and the current pullback of about 2.8% is still normal compared with recent history. Oil easing on Friday helped SPY stabilize, but crude, tariffs, and elevated treasury yields still make failed rebounds more dangerous. The next chapter goes directly into crude oil, because that shock is now one of the main forces deciding whether this breakdown accelerates or buyers get another chance. The oil shock behind the pressure on SPY intensified through Thursday as fighting and shipping threats raised supply fears. Friday's retreat lowered the immediate heat, but it did not remove the inflation and interest rate risk. Current price is still above both major moving averages, so the geopolitical rally has not broken even after the pullback. The 50 days moving average has held beneath crude for 3 sessions. That keeps the near-term advance alive, but the latest inside day says momentum has paused. The resistance line near 102 is the next serious test. I still lean toward rejection until crude can clear that cap and stay above it. RSI has slipped back below 70. The overbought push is cooling, but momentum remains above 50, so sellers have not taken full control. The rising support line near 78 is the failure point. A break through that floor would turn the war premium into another failed rebound, while a firm reclaim of resistance would flip the call. For equities, that leaves a difficult mix. Oil is no longer accelerating, but it is still high enough to keep inflation and yields in the conversation. Next, Alphabet has to show whether heavy AI spending can survive that tougher valuation backdrop. Alphabet is now dealing with 2 pressures at once. The earnings reaction raised fresh questions about heavy AI spending and negative free cash flow, while higher oil and bond yields made expensive technology stocks harder to defend. Price has dropped from roughly 393.88 to 314.90, and it is sitting close to that low. That makes a short-term bounce possible, but it does not repair the damage by itself. The first rebound hurdle is near 333.54. I would expect sellers to test any weak rally into that level. The more important resistance zone runs from about 345 to 363.71. A rebound into that area still looks like a sellable move unless buyers can reclaim the upper end and hold it. 314.90 remains the immediate downside line. If that level breaks and price stays below it, the next extension begins opening near 293.42. So Alphabet may bounce after an unusually sharp decline, but rejection risk still has the edge while price remains below the retracement zone. That weakness also supports the broader warning from SPY that technology rallies are vulnerable until resistance is properly reclaimed. The economic calendar comes next because rates, inflation pressure, and the Federal Reserve now decide whether growth stocks get room to recover or face another valuation hit. Let us have a look at the calendar for next week because Alphabet and the broader technology trade now need help from rates. Wednesday, July 29th brings the Fed rate decision, the policy statement, and the press conference. Traders expect no change, but they are watching for any warning that another rate increase is getting closer. A patient Fed would take some pressure off yields and help buyers. A surprise hike, or a tougher message on inflation, would make any rebound in growth stocks much harder to trust. Thursday, July 30th brings core PCE inflation. Cooler monthly inflation would give the Fed more room to wait, while another sticky result would keep yields high and give sellers another reason. The same Thursday release block also includes annualized GDP and the GDP price index. Steady growth with softer price pressure would be good for stocks. Strong growth with stubborn inflation could still hurt, so the balanced version is simple. If inflation cools and growth stays firm, buyers get room for a bounce. If prices stay hot or the Fed sounds tougher, the rejection risk remains active. From what I am seeing in the news and current positioning, I think sellers have the edge going into this calendar. The market finishes this week under pressure, and I still think rallies are more likely to fail than turn straight into a fresh breakout. The resistance zone around 745 is the line buyers have to reclaim before I trust any rebound. The overhead gap from roughly 742.6 to 746.4 makes that area even more important. The lower Bollinger area near 733.6 is where the current pullback now meets its first serious test. RSI at 45.2 is weak, but it is not washed out. Sellers still have room to press before momentum reaches an extreme. MACD is rolling over above zero, while ADX near 19 says this is still more rotational than a powerful one-way trend. That matters because oil, tariffs, and elevated yields are still making weak equity rebounds easier to reject. Again, buyers can produce a bounce here. I just do not want to confuse a bounce with a repaired market. The key resistance area near 745 remains the line in the sand. Below it, sellers still have the better argument. The first support shelf around 733.6 needs to hold into the close, not just survive an intraday dip. A quick break below that shelf followed by an immediate recovery would keep the market trapped in rotation rather than confirm a larger failure. Okay, so what does all of this mean for the next move? Let's shift the chart forward and look at what could come next. The route I think is most likely right now is a rebound that struggles underneath resistance and then turns lower again. The resistance cluster around 745 is where that rebound has to prove itself. Another rejection there keeps downside pressure active. The open gap between roughly 742.6 and 746.4 could still become a fill and fade instead of a clean recovery. The support zone around 733.6 is the next stop if buyers fail at that overhead area. The lower Bollinger area at the same level is why I want a closing breakdown before treating the move as real follow-through. The first downside extension opens near 720.2 if sellers break support and keep price accepted underneath it. The next larger downside objective begins around 713.6, with the weekly 40-period average near 700 adding another reaction area. The deeper support cluster around 696.8 is where I would expect the bearish move to slow down or produce a stronger bounce. The upside route starts only if buyers reclaim 745 clearly and hold that recovery into the close. The upper resistance cluster near 758.7 then becomes the next place where supply can return. There is some support for that bounce risk. After prior 50-day average reclaims, SPY was higher one session later about 62% of the time. So do we fill the gap and fade, or do buyers finally absorb 745? I still give rejection the edge until that resistance is reclaimed. Thanks for watching. Stay disciplined, manage the risk, and I will see you in the next weekly market recap.